Most people think building wealth is linear. You save a little, it grows a little, you save more, it grows more. A steady, predictable climb. And for the first several years of investing, that is exactly what it feels like. Slow, almost tedious, the kind of progress that is easier to ignore than to celebrate. But there is a number, a specific threshold. And when your portfolio crosses it, something changes that nobody in your life will mention, your employer will never explain, and most financial content never isolates clearly enough to make you feel it. That number is $250,000. Not a million, not 500,000, 250,000. An amount that feels significant but not extraordinary, reachable but not easy. And what happens at this threshold is not a change in strategy, not a new account type, not a different set of rules. What changes is the math itself. The portfolio begins doing work that your contributions alone could never do. And if you do not understand why this happens, you will misread your own progress for years, either losing patience too early or failing to protect the momentum once it arrives. My name is Anderson. And today, I want to show you exactly what happens at the $250,000 mark, why it happens, and what you need to do and stop doing to make sure you reach it and keep what it gives you. Let me start with something that will reframe the entire conversation. Most people measure their financial progress in terms of how much they contribute, and in the early stages of building wealth, that measurement is essentially correct. When your portfolio holds $15,000 and you contribute $500 a month, your contributions are the dominant force in your account's growth. The market returns on $15,000 are relatively modest. You are the engine, your discipline, your monthly transfer, your willingness to delay consumption, those are what move the number. This is why the early years feel hard, because they are hard. You are carrying the portfolio almost entirely on your own effort. The math has not yet begun to work in your favor at any meaningful scale. But here is what changes as the balance grows. Every year, your investment returns are calculated as a percentage of your total balance, not your contributions. So, as the balance increases, the absolute dollar value of that percentage increases with it, and at $250,000, assuming a historically reasonable 7% annual return, your portfolio generates approximately $17,500 in a single year without a single additional contribution from you. Think about that. $17,500 from a portfolio sitting still. That is more than $1,400 every month produced entirely by compounding, by money that has been accumulating long enough to start pulling serious weight. And unlike your salary, unlike your monthly transfer, this income does not require your time, your energy, or your presence. It arrives whether you are working or resting, whether the economy is calm or turbulent, whether you feel motivated or exhausted. This is the acceleration point, not because you did something different, because the math crossed a threshold where the portfolio's own momentum begins to rival your personal contribution. Now, I want to show you this in concrete terms, because the numbers tell a story that abstract language cannot fully capture. Imagine two people, both earn the same income, both begin investing at the same age, with the same monthly contribution of $600. The only difference is that one of them understands what is coming at $250,000 and the other does not. The one who does not understand it reaches the $200,000 mark after roughly 17 years of consistent contribution, watches the growth feel slow and incremental, grows frustrated, reduces contributions during a market downturn, and effectively stalls his own momentum just before the acceleration begins. The one who understands it reaches the same $200,000 mark, recognizes that he is approaching a threshold rather than a plateau, protects his contribution rate through the downturn because he understands that disrupting the base now is the most expensive mistake he could make, and crosses $250,000 2 years later. From that point, the trajectories diverged sharply, not because of luck, not because of different strategies or superior intelligence, because one person understood what the threshold meant and protected it. The other did not, and his impatience cost him the compounding years that were about to do the heaviest lifting of his entire financial life. There is a psychological dimension to this that matters as much as mathematics. The years between 0 and $250,000 feel like you are building something that requires constant maintenance. Miss a month of contributions and you feel the gap. Face a market decline and your balance drops by amounts that feel personal. The portfolio at this stage is sensitive to disruption because your contributions are its primary fuel. Every interruption matters. This creates a specific kind of financial anxiety that is actually appropriate. At this stage, your behavior is the most important variable. Consistency, protection of contributions, avoidance of unnecessary withdrawals, these behaviors are not just good habits, they are the literal mechanism of progress. The anxiety that keeps you contributing is working in your favor, but after the $250,000 threshold, something important shifts in what actually drives your outcome. Your behavior still matters, but the portfolio's own momentum has become a significant force. A 7% return on $250,000 adds more to your balance in a single year than 10 months of $600 contributions. Math has changed its own character. The investor who understands this transition stops measuring their progress exclusively through the lens of monthly contributions and starts understanding their portfolio as an entity that has developed its own velocity. They protect the base not out of anxiety, but out of respect for what the compounding engine has become. If this is making sense so far, take 2 seconds and hit the like button. It genuinely helps this channel reach more people who need to hear this. Now, I want to address the trap that derails more investors at exactly this stage than at any other point in the wealth building journey. The $250,000 portfolio looks like a reward. After years of disciplined saving, years of watching the balance grow slowly, years of delayed gratification, $250,000 feels like an achievement that deserves recognition. And it is an achievement. The discipline that produced it was real. The sacrifice that fed it was real. But the portfolio at this stage is not a reward. It is a seed at its most critical moment of growth. The investor who treats it as a reward withdraws a significant portion for a lifestyle upgrade, a newer car, a larger home, an extended vacation, and in doing so, removes the base that was about to trigger the acceleration. The compounding engine does not care about the reason for the withdrawal. It recalculates from whatever remains, and the years of momentum required to rebuild what was removed cannot be purchased, borrowed, or recovered through higher future contributions. Time is the only input that produces compounding, and spent time does not return. Consider the specific cost. A withdrawal of $40,000 from a $250,000 portfolio at this stage does not cost $40,000. Over the following 20 years, at 7% annual returns, that $40,000 would have compounded to approximately $150,000. The lifestyle upgrade that felt like a $40,000 decision was actually a $150,000 decision. The car depreciates, the vacation ends. The compounding that was interrupted continues its absence permanently. This is not an argument against ever spending money. It is an argument for understanding what you are actually trading when you interrupt momentum at precisely the moment it is becoming most powerful. And if you're actually getting something out of this, consider subscribing. I make videos like this every week, grounded, mathematically honest, no hype. Let me show you what protecting this threshold actually produces. A $250,000 portfolio contributing $600 monthly and earning 7% annually will reach $500,000 in approximately 8 years. That same portfolio, once it reaches $500,000, will reach $1 million in roughly 10 additional years with no increase in monthly contributions whatsoever. The first $250,000 took the longest. The next $250,000 took 8 years. The $500,000 after that will take 10, and the million after that will take less. The curve is real, the acceleration is mathematically documented, and it arrives not because anything external changes, but because the portfolio's own scale has crossed the threshold where compounding produces annual returns that dwarf monthly human contribution. The investor who understands this does not need a higher salary to accelerate their outcome. They need to protect the base, maintain the contribution rate, and allow time to do what time does when given an appropriately sized portfolio to work with. Here is what I want you to do with this. First, calculate exactly where you are relative to $250,000. Not approximately, exactly. This number should be a landmark on your personal map, not an abstract milestone someone else is chasing. Second, examine your contribution rate and ask honestly whether it is protected against the most likely disruptions, an unexpected expense, a market decline, a period of reduced motivation. The emergency fund that prevents investment withdrawals during difficult periods is not separate from your wealth building strategy. It is part of it. Third, if you are currently above $100,000, understand that you are in the most psychologically demanding stretch of the journey. The progress feels slow relative to the effort. This is mathematically expected and temporary. The acceleration is structural and guaranteed by the math, but only for the investor who remains consistent long enough to reach the threshold. Fourth, make a specific decision about lifestyle inflation. Not a vague commitment to spend less, but a concrete boundary around your investment base. Decide in advance what portion of any income increase goes directly into the portfolio before it becomes available for consumption. The investor who automates this decision removes it from the domain of monthly willpower. Here is where I want to leave you. The $250,000 acceleration point is not a secret. The mathematics are public, verifiable, and ancient. What makes it feel like a secret is that nobody frames it as a threshold with a specific character, a point where the nature of your portfolio's growth changes, where your role shifts from primary engine to patient steward, where the most important thing you can do is stop interrupting something that has finally learned to run on its own. You started this video knowing that compound interest works. You knew that patience matters and consistency matters and time matters. What I hope you leave with is something more specific than that, the image of a particular number, a particular moment in your financial life where the math crosses a line and the portfolio begins pulling you forward rather than waiting for you to push it. Protect that moment. Work toward it with the understanding that the years before it are an investment in the years after it. And when you arrive at it, resist every impulse to treat it as a destination. It is not a destination. It is where the real journey begins. Thanks for watching. My name is Anderson, and I'll see you in the next video.